Hi there and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy and I'm Senior Analyst for ETF.com. This week I'm talking with Ryan Charles, Principal at Kelley Hunt Charles LLC, an asset management law firm. Ryan, welcome to the show.
Thank you. Thank you so much for having me, Sumit.
Ryan, just a few weeks ago, the SEC adopted amendments to a rule regarding registered fund names. The SEC said that the amendments were intended to, quote, modernize and enhance investor protections given the important information that fund names can convey to investors. What does this mean for ETF fund names going forward?
Well, that's a great question. We're an industry of disclosure, right? I mean, it's all about disclosure with what we're doing. And I think to narrow it down in one short phrase, say what you do and do what you say, right? I mean, that's what they're asking of us. And I think that's what we as an industry want to do. But, it's a lot easier said than done. There's, and if you look, I don't know if you had a chance to look through the final release, but, they use in there a very good example of Latin America. What is Latin America? Does it include these countries? How about those countries? And so again, thankfully, if what it means for ETFs coming out is if they're partnered with the right individuals and if they have the right people with them, they're going to have some very thoughtful discussions on the front end so that they don't have any trouble on the back end. So they're going to be thoughtfully putting together their disclosure documents so that it's fulsome and it says exactly what they're going to do, and then they do that. I know we've had some releases, and I think even was it this week or last week with some folks that had some issues, I think, with not doing what their documents said they were going to do, and that's what it all comes down to. It seems so simple and saying it, but having done this now for 20 plus years in practice, it's really hard. I mean, I think back to an example where at one point in my life, a manager wanted to look at managing financial securities. And they had a financial portfolio, and it was great. But one of the holdings in there was Visa, and Sumit, I don't know what your thought would be on Visa. I'm like, oh, good, yeah, it's my card. It's like to me like a banking institution, it's a financial institution. Well, GIC says it's information technology. It's more like Google or something. I thought, oh no. So imagine the portfolio manager's surprise when you're like, oh, you thought that was a financial? No, it's. So that's why I say it's easier said than done. But the one cool takeaway is that when we collaboratively work together, the regulator and us, the industry, things can be done in a very positive way. And so when you look at the recent adoption here with the names rule, the fact is that there is a significant amount of flexibility for managers. And like in my example, Latin America, they will have the ability to, appropriately define Latin America, and so that's where that flexibility has been provided for us. We just need to be very thoughtful about it. And I think the hardest thing is that let's not kid ourselves. This is going to cost money. The implementation of every new rule requires funds. And at some level, when funds are required, that can impact shareholders, right? Because expenses are impacted. So we just want, I think everybody should want to make sure that the rules being adopted really provide a benefit to shareholders that outweigh the expenses related thereto.
Well said. Ryan, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Yeah, no, thank you.